For a long time, I believed trading was a game of logic. I thought the more I studied, the deeper I practiced, the better I understood technicals, the money would naturally follow. I went through candlestick patterns relentlessly, cycled through countless indicators, filled my charts with supply and demand zones, yet my account stayed red. The irony was that most of my trades were correct by the book, correct by the system, only the outcome was wrong, consistently wrong. Every time I took a loss, I told myself the same thing: I'm just not patient enough. But deep down, I knew that wasn't the truth. The problem was more fundamental than that. Everything was wrong at the root. That changed when I met my mentor. He didn't teach with slides. He didn't trade live on screen. He never shouted entries or exits. In fact, he didn't teach technical analysis at all. The only thing he passed on was a way of seeing, the ability to notice what most of the market completely misses. I still remember one rainy evening clearly. I brought my laptop, opened the AUD-USD chart, and said, "Sir, I think the market will keep falling. It just broke the low." He didn't even look at the screen. He asked me one question: if everyone has already sold, who still has the courage to sell next? I froze. And in that moment, I realized something uncomfortable. I didn't truly understand what I was doing. I was simply trading the expectations of the crowd, just like thousands of others, equally blind. That night, he told me about 6 steps he goes through before every trade. He called it reading the market's blind spots. He said, if you want to survive long enough, don't try to predict where price will go. Learn to recognize when the whole world is believing something that is wrong. From that day on, I stopped seeing the market as a chart. I started seeing it as a collective emotional flow. And today, if you're still stuck the way I once was, executing trades that look technically correct, yet ending up on the wrong side, if you've ever asked yourself why you were right but still lost, then perhaps you need to hear the 6 steps my mentor left behind. Not a theory, not a course, but a path meant only for those who truly want to survive. In a moment, I'll share the first step, the one my mentor always takes before he even glances at a chart. But before we go further, I want to say a few words to those who've been here, who followed me for a while. When I started this channel, I never intended to talk much about strategy. What I use isn't easy to accept and even harder to understand, especially through short podcast-style videos. But over time, I realized something. Too many people are still losing, still lost right inside this market. And I thought, if even a single sentence from me can help someone see a little more clearly, then sharing is worth it. If just one small piece can help you go a little further, think a little differently, that's enough for me. I know a 20-minute video can't explain everything, so if there's anything you find unclear or want to explore deeper, leave a comment. I'll read them, I'll gather them, and I'll explain further in the videos to come. We'll walk this path together, slowly, steadily, and over time, you'll begin to see the market with different eyes. My mentor doesn't live in a financial district, no suit, no cold office, no 3-monitor setup. He lives on the outskirts, he raises fish, he grows trees. No one there cares whether the Dow is up or what the Fed just said, yet his account is larger than many voices you see on Bloomberg. He speaks little, and he has never formally taught trading to anyone. I didn't go to him to be taught, I went to observe how a person can remain calm in the middle of the most violent financial storms. The first time I followed him, he said, "You don't need to learn anything. Just sit still, watch the market, and listen to your own thoughts." I didn't understand. I believed trading was about analysis, prediction, risk calculation, but he never predicted. He sat before a blank chart, no indicators, no volume, no RSI, no Fibonacci, just an empty chart. His eyes were deep and quiet, as if he were having a conversation with the market itself. I asked him, "What do you see in a chart like that?" He smiled and said, "I'm not looking at the chart. I'm watching how the market is lying." From that day on, I never looked at charts the same way. I began to learn how to feel the market. There's one sentence my mentor said that I've never forgotten. The strongest trader isn't the most skilled one. It's the one who survives long enough to place the next trade. He didn't need to be right often. He didn't trade every day. He waited. And when the moment arrived, he acted quickly, cleanly, decisively, no repetition. Once I asked him, "Is this trade with the trend or are you catching a bottom?" He replied, "Neither. I just need to know that right now the crowd is blind." I'm not telling you this to glorify anyone, only to help you understand this. There is a hidden layer in the market, people who don't show off, who don't make noise, yet survive through every storm. My mentor is one of them. He doesn't need fame, he only needs to know that today his account is still alive. And if the market reverses tomorrow, he still has the strength to continue. Before starting this video series, I called him, not to ask for signals, but to ask for permission. There was one thing I always knew for certain. My mentor never wanted to be seen. He didn't want to appear anywhere, and he especially didn't want to be labeled as a trading guru online. He hated noise, he hated spotlights, and he always reminded me one thing. The market only pays those who know how to keep their mouth shut. That phone call happened around noon. I was sitting in a small cafe, a soft breeze coming through the window. As I dialed his number, my hand trembled slightly, not of fear, but of respect. He picked up. His voice was slow, steady, unrushed, just like always. I told him I wanted to create a video series, not to show off a strategy, not to teach people how to get rich, just to tell a story, to pass on what I had absorbed, what I had paid for with real losses. He stayed silent for a few seconds. Then he gave a quiet laugh, a very light one, and said, "Just don't mention my name." Then he laughed again. No long explanation, but in that silence there was full permission. I understood, and it was that quiet approval that gave me the reason to continue, to share what I believed could pull someone back from the edge, from the moment just before they collapse inside this market. I don't promise you'll make money after watching these videos. I only hope you'll lose less, be less confused, and feel less alone on this path. Because I know how many people are losing, not because they're incapable, but because no one ever taught them to see the market as a living entity with emotions, beliefs, and collective mistakes. If what I'm about to share helps you understand just a little more, then I believe that midday call and my mentor's quiet smile were worth it. And now I'll begin with the first step of the 6 steps he passed down to me, the opening step and the foundation that everything else depends on. If you're ready, let's continue. The first step is not a setup, not a pattern, not a way to follow a trend. It's a very simple question. Where is the money flowing? My mentor used to say, if you don't know where the money is going, you're standing in the desert without a compass. Don't place a trade when you don't yet know who's winning and who's panicking. The first thing he does every morning is to look at reality, not emotion. No guessing, no interpretation. I once thought he spent his time reading news, but he didn't. He didn't read the news, he watched how people with money reacted before the news. Every morning he opened Trading Economics, not to read headlines, but to look at 10-year government bond yields from major economies. The US, Japan, Germany, the UK. If US yields were rising steadily, he said the market was placing confidence in the dollar. If yields were falling while economic data looked strong, he would simply shake his head and smile. People with money don't believe the data, they're already worried. He didn't use indicators. He focused on real interest rates, yields adjusted for inflation expectations. That's what large capital cares about. Beginners only look at yesterday's candle. The second step was relative comparison. He warned me never look at a single currency pair in isolation. Whenever I asked, "Do you think this pair will go up or down?" he would open several charts at once: AUD USD, GBP USD, AUD USD, USD CHF, EUR JPY, and the dollar index. If the dollar was weak across the board, there was nothing to guess. The money had already left. He didn't draw anything. He didn't add indicators. He simply looked and felt which side the market was leaning towards. The third step was reaction after the news. Not whether the news was big or small, but how price responded. I remember one time when non-farm payrolls came out very strong. The dollar jumped immediately. I was about to buy. He stayed still, waited. 10 minutes passed. Then he said, if after 15 minutes,
once he had identified where the flow of money was leaning, the next thing my mentor always did was search for what the crowd was getting wrong. He called it finding the cracks in the wall of belief. My mentor once said something that sounded almost backwards. The market does not operate on truth. It operates on what the majority believes to be true. Good news comes out, they buy. Bad news is released, they sell. They believe they are reacting logically, but my mentor warned me, it is not the event itself that creates the shock. It is the expectation before the event that truly moves the market. Case 1. Good news, but price refuses to continue. I remember a time when US CPI came out lower than forecast, widely seen as positive news. The crowd immediately concluded, inflation is cooling, the Fed will turn less hawkish, the dollar should weaken. USD JPY dropped nearly 60 pips in a short span. I turned to my mentor. He said nothing. About 15 minutes later, price reversed. Not only did it recover, USD JPY surged even stronger than the initial drop. My mentor exhaled lightly and said, good CPI, yet the dollar couldn't fall further. That means sellers were already positioned before the news. Now there's no one left to sell. Those who sold based on the headline were now trapped. Case 2, bad news, yet price rises. Another time, European GDP was released far worse than expected. Euro USD dipped slightly and then stopped. Less than 30 minutes later, it began to rise strongly. I didn't understand. My mentor simply smiled. The market priced in the fear before the news came out. When the event arrives and price can't extend further, expectation has already been exhausted. He called this moment when the market betrays expectation. Whenever price moved against popular belief, my mentor became alert, not to enter immediately, but to observe more carefully. He always waited for the second reaction, the reaction that comes when the crowd slowly realizes they might be wrong. To identify that moment, he watched 3 things. 1. Does the price reaction match the content of the news? 2. Volatility during the Asian and European sessions, where the market reveals its true nature most easily. 3. Price zones that react strongly but fail to extend, places where expectation is being rejected. If price reacts violently but cannot expand its range, it's a sign that the story the market is telling is losing credibility. The core idea of this step is simple. The market always tells a story to attract belief. The winner is the one who recognizes when that story is no longer believed. My mentor once said something that sounded almost backwards. The market does not operate on truth. It operates on what the majority believes to be true. Good news comes out, they buy. Bad news is released, they sell. They believe they are reacting logically, but my mentor warned me, it is not the event itself that creates the shock. It is the expectation before the event that truly moves the market. Tonight, try this simple test. When you see strong news, ask yourself, who is believing this story? If the price tries to move in a direction and fails to extend, what will they do? The moment you see the price betray expectation, you will be one step ahead of the crowd. The next step is entering, but not to win. Once my mentor sensed the smell of misplaced belief, he never entered with a full position, never. He always began with an action whose value I only truly understood later, a probing trade. I once asked, "You already see it clearly. Why not enter strong right away?" He looked at me for a moment and said, "If you don't know how the market reacts to a small cut, don't draw your sword for a full strike." A probing trade isn't meant to make money, it's meant to listen. Very small size, no profit expectation, no tightening of stop losses, no need to prove oneself right, just a light tap on the market to see how it responds. After placing that trade, he watched three things. 1. Can the market absorb the order? If price moves sharply against him, he exits immediately, no argument. 2. Does the rhythm of volatility change? If price slows down, he waits. If panic begins to surface, he becomes alert. And 3. Does the opposite side fight back? If price hesitates and then moves in his direction, it's a sign that the balance of belief is starting to crack. An example I'll never forget. After US GDP data was released, the market rushed to buy the dollar. Odd USD dropped nearly 70 pips. My mentor did nothing. He waited until price stopped falling and began forming a tight range. Then he placed a very small buy order. I asked, "Are you catching the bottom?" He smiled. "No, I'm just asking the market a question. If I push gently, how will you respond?" Price went sideways, then edged higher. He said nothing. A few minutes later, he entered again, this time 3 times larger. No rush, no emotion, only action after the market had answered for itself. Next, I'll tell you about the next step, how my mentor expands a position once he has felt the market's breathing. If you've ever lost because you entered too early, this part may force you to rethink everything you have done up to now. We'll continue, slowly but truthfully. The most important thing behind a probing trade is this: it is not meant to make money. It exists for only one reason: to confirm whether your sense of the market is right or wrong. My mentor never traded like a gambler. To him, every order placed was like a question sent directly to the market. If the answer was clear, he moved forward. If the answer was vague, he stepped back. I once watched him exit a trade in less than 10 minutes, not because he was cold, but because he understood one thing with absolute clarity. To survive long-term, you must know how to lose the right way. The strongest trader isn't the one who never loses, it's the one who loses without losing his life in the market. And that is something very few people are willing to talk about in trading. Once the probing trade gave a clear signal, my mentor stopped being gentle. He called it the moment of the decisive strike. If you've ever asked yourself, when should I go in big? This is the answer no course will ever teach you. My mentor was extremely patient. He could observe the market for an entire week without placing a single trade. But when the market exposed a weakness and the probing trade confirmed it, he acted fast. He only went in with full force when 4 conditions were met. 1. The probing trade was already in profit and the market showed no resistance. 2. Price behavior indicated that the crowd was beginning to panic. 3. Large money started flowing in the same direction as his position. And 4. Time passed and no one had the courage left to trade against it.
He didn't enter aggressively because price looked right. He entered aggressively when others were wrong, but hadn't realized it yet. And situation I'll never forget. After U.S. inflation data was released, the market believed the Fed would continue raising rates. The dollar surged across almost every pair. Everyone was shouting, "Buy USD." My mentor stayed still. About 30 minutes later, USD JPY began to weaken. He already had a small position in place. When price broke below a major support level and no buying pressure appeared, he entered a second position, 5 times larger than the first. I asked him, "Are you sure?" He answered calmly, "I'm not sure, but I know the buyers are exhausted and they will be the ones forced to cut in panic." A few hours later, USD JPY fell nearly 100 pips. That was an attack, but not a gamble. I once thought he was all in. He wasn't. He divided his account into layers. The first trade was for probing. The second was for confirmation. The large position only appeared when the market began collapsing into its own belief. He once told me, "You don't need to go big to win. You only need to go big at the right moment." The final signal he waited for was the break of the belief equilibrium zone, where both sides had previously been locked in struggle. No meaningful pullback. The weaker side was exhausted. Good news was released, but price could not hold. Expectation officially collapsed. The market began forcing positions in the opposite direction. That was when the market became most fragile. I've seen him take just one trade in an entire month and
There are times when the setup looks perfect. The news is on your side, price hasn't moved against you yet. I once asked my mentor, "Why don't you wait a bit longer? Price isn't wrong." He answered briefly, "Right or wrong doesn't matter. What matters is whether the market still agrees with you. If the reaction doesn't unfold as expected, then you're wrong. That's it." My mentor always placed a stop loss, but most of his losing trades were cut before price ever reached it. Not out of fear, but because he never waited for the market to prove him wrong. He needed only one signal. The market stopped responding. If price failed to move in the expected direction within a reasonable amount of time, he stepped out. He once told me, "Don't stand there waiting for the market to slap you hard before you decide to run." I've seen him lose 3 trades in a row. Each loss was small. No one noticed, no panic, no emotion. Then came the 4th trade. He struck decisively, not only recovering everything, but making several times more. That was when I understood his core belief. Loss is not failure. Loss is the cost of staying in the game. No one walks into a casino without paying for a seat. Cutting losses is the ticket price. If you want to stay seated, you pay. I asked him, "Do you ever regret cutting a trade too early?" He smiled. "Yes, for about a minute, but regretting not cutting can cost you a whole month." How he decides to cut. His rules were very clear. Price moves against him, hasn't hit stop yet, but the market goes silent. Cut. Good news is released, but price can't move. Cut. Money flow clearly shifts direction even if the trade is slightly profitable. Cut. He never held a position just because he was already in. He only stayed as long as the market continued to support him. Why did my mentor never hold and hope? He said, "A trader who holds and hopes is someone trying to be right emotionally, and the market doesn't pay for emotions. You are allowed to be wrong. Just don't let that mistake push you out of the game. If you want to win big, you must still be alive for the next round." And there was one sentence he said that I will never forget. "If you don't learn to cut losses early, one day the market will cut you in half." Step 6. Adding size when the opportunity is confirmed. This is the final step, and also the most misunderstood one.
My mentor once said, "When you're right, don't just stand there smiling, strike one more time." When I was younger, I believed that once you're in profit, you should do nothing, just sit still. My mentor thought differently. When he saw the market reacting exactly as expected, when the opposing side began to break and run, he didn't watch, he added to the position. He used an analogy I still remember. If you've entered the right house while it's burning, don't bring just one bucket of water, bring the fire hose. But he never added blindly. He never held winners the way many people teach. Every additional position was carefully calculated, and it only appeared when the market allowed it. He added size only when price broke a key level with no meaningful pullback. Volatility expanded without real resistance. Large money was clearly committed to one side. Adding positions wasn't about satisfying greed, it was about maximizing advantage during a rare moment. Because moments like that don't appear many times in a year. And when they do, the ones who survive are the ones who know how to go further than the crowd. I remember very clearly one example my mentor once showed me. GBP USD had just gone through a series of consecutive bad news releases. The pound was being sold relentlessly. Before that, my mentor already had a small short position. When price broke below the low from 3 weeks ago and showed no meaningful rebound, he added a second position. Then the market bounced slightly, a weak pullback to retest the broken level. He waited, then he entered a third position. I asked him, "Aren't you afraid the market might reverse?" He smiled and said something I will never forget. When the other side has already lost its spirit and you're still hesitating, you don't deserve to command the army. My mentor had very strict rules when it came to adding size. He never added unless the first position was already clearly profitable. He never added while the opposite side still had strength to fight back. Every additional position had its own breathing room. Stops never overlapped. To him, adding size was never about proving how good he was. It was about extracting every ounce of value from an opportunity before it disappeared. I once asked him, "Have you ever added at the wrong time?" He nodded, "Yes." Then he added, "And when I add wrong, I cut faster than the first position." This was the final mindset he left me with. Big opportunities in the market do not come every day. Sometimes an entire year offers only a few truly clear moments. In a week, there may be just one point when the crowd's belief begins to collapse. In a single day, there may be just a few minutes when all resistance disappears. And if, at that moment, you are holding a position in the right direction, the question is no longer, should I keep holding? The real question becomes, am I wasting one of the very few opportunities that can make up for dozens of stop losses before this? My mentor often said, "There's nothing wrong with going big. What's wrong is going big before you know you're right." That is the difference. He only added size when every signal had already confirmed. The crowd no longer believed in the old direction. The opposite side was being forced to exit. Price responded correctly to every retest, and most importantly, there was no longer any real counterforce at the critical moment. I asked him, "What if you're wrong?" He answered calmly, "If I'm wrong, I cut, but if I'm right, I must size it big enough to deserve being right." Adding size was never about getting rich quickly. It was about not living with regret. He taught me one final rule. If you're not willing to give back part of your current profit, never think about adding to a position, because every add puts your conviction back on the scale. You must accept that the market can still turn. And he concluded, a great trader isn't the one who wins the most trades. It's the one who wins big at the right moment. Knowing when to be patient and knowing when to be decisive. So now, you've walked with me through the 6 steps my mentor passed down, from reading the flow of money, to understanding crowd belief, to probing, to striking at the right time, to cutting losses in order to survive, and finally, to expanding when the real opportunity opens.
This is not just a strategy. It's a way of living inside the market. No flash, no noise. Just 6 steps, simple enough to fit on a small piece of paper, yet deep enough to keep you alive where most fall to their own emotions. This strategy doesn't promise you will win every trade. It only teaches you when to stay still, when to act, and when to let go. That is what my mentor gave me, and today I give it to you the same way he gave it to me, once and without repetition. If there's any part of these 6 steps you're still questioning, or any point you want to explore more deeply, leave a comment below. I'll read them, I'll gather them, and I'll clarify them further in future videos, so you don't just understand, but actually live each step of this approach. This is the end of the 3-part series, but it's not the end of the journey. If you're still here, I believe you don't belong to the crowd. And when everything starts to turn chaotic, you'll be the one calm enough to go further. We'll meet again in the next video. A new chapter, quieter, deeper, and perhaps a real turning point on the path you're walking. I remember very clearly one example my mentor once showed me. GBP USD had just gone through a series of consecutive bad news releases. The pound was being sold relentlessly. Before that, my mentor already had a small short position. When price broke below the low from 3 weeks ago and showed no meaningful rebound, he added a second position. Then the market bounced slightly, a weak pullback to retest the broken level. He waited, then he entered a third position. I asked him, "Aren't you afraid the market might reverse?" He smiled and said something I will never forget. When the other side has already lost its spirit and you're still hesitating, you don't deserve to command the army. My mentor had very strict rules when it came to adding size. He never added unless the first position was already clearly profitable. He never added while the opposite side still had strength to fight back. Every additional position had its own breathing room. Stops never overlapped. To him, adding size was never about proving how good he was. It was about extracting every ounce of value from an opportunity before it disappeared. I once asked him, "Have you ever added at the wrong time?" He nodded, "Yes." Then he added, "And when I add wrong, I cut faster than the first position." This was the final mindset he left me with. Big opportunities in the market do not come every day. Sometimes an entire year offers only a few truly